Hi there. In this video, we explain how to calculate your net take-home salary in the UK for 2026 after PAYE tax and national insurance deductions.
So what will your UK take-home pay really look like in 2026? It's a question on pretty much everyone's mind. Today, we're going to break it all down from that big salary number all the way to what actually lands in your bank account. Now, this explainer was put together for us by the tax advisors over at Fairview Accounting Services. They're the pros who help UK businesses and individuals get their heads around tax compliance. So, we're in good hands for tackling this tricky subject.
Okay, let's just jump right in with a real-world situation. Picture this. You've just been offered a new job, and the salary is £60,000. Fantastic, right? But we all know that 60 grand isn't what you'll actually see each month. So what will you really take home? Let's figure it out.
So here's our plan. We're going to take a little journey from your gross pay to your net pay. We'll start with that top-line salary, and then, piece by piece, we'll peel back the layers. Income tax, national insurance, pensions, even student loans, until we get to that final take-home figure.
All right, first up, let's get the big picture. What are the main things that are going to affect your pay packet in 2026?
Okay, the number one thing you need to know about for 2026 is something called fiscal drag. I know it sounds a bit jargony, but it's actually pretty simple. The government has frozen the tax thresholds, and they're staying frozen till at least 2031. This means that as wages go up, even just with inflation, more of your money gets pushed into a higher tax bracket. So you get a pay rise, but you end up paying more tax, and you don't actually feel any better off. It's a sneaky one, and it's exactly why we need to get to grips with our pay slips.
So the first key number to lock in your brain is £12,570. That's your standard personal allowance for 2026. Think of it as your tax-free chunk of earnings. You don't pay a penny of income tax on this amount. But, of course, there's a little twist, especially for higher earners. As soon as you start earning over £100,000, that lovely tax-free allowance starts to shrink. Here's how it works. For every £2 you earn above that mark, you lose £1 of your allowance. And by the time your salary hits £125,140, poof, your entire personal allowance is gone. Okay, let's talk about the first big deduction, income tax. And this is where it gets interesting. Because believe it or not, here in the UK, we're actually dealing with two totally different systems. Yep, you heard that right. There's no single set of income tax rules for the whole country. Where you live actually changes how much tax you pay. Your pay slip is going to look different if you're in Scotland compared to if you're in England, Wales, or Northern Ireland. Your postcode literally makes a difference. So if you live in England, Wales, or Northern Ireland, this is the system for you. And remember, all this kicks in after your personal allowance. So you pay the basic rate, which is 20% on your taxable income up to £37,700. Then, for everything between that and £125,140, you're on the higher rate of 40%. And if you earn anything above that, you hit the additional rate, which is 45%.
But what if you're in Scotland? Well, things look quite a bit different. They have a much more detailed system with, get this, 6 different tax bands. It starts at a 19% starter rate and goes all the way up to a 48% top rate. As you can probably tell just by looking at it, the bands and the rates are completely different, and that can really change your final take-home pay.
All right, once the tax man has taken his income tax, we've got the next big one to deal with. It's called national insurance, but let's be honest, most of us just think of it as a second income tax, don't we? So if you're an employee, you'll be paying what's called Class 1 national insurance. And you'll spot that the starting line is the same as for income tax. You pay 0 on anything below £12,570. On your earnings between that amount and £50,270, you'll pay 8%, and then for everything you earn above that, the rate drops right down to 2%.
Now, the next thing coming off your pay is a bit different. It's a deduction, yes, but this one is actually for you. We're talking about your pension contribution. This is money that's being put away and invested for your future self.
You see, because of something called auto-enrollment, most people are now automatically saving into a pension at work. The rules are super simple, really. If you're over 22 but under state pension age and you earn more than 10 grand a year, your boss legally has to pop you into their pension scheme. It all happens automatically. So, how much actually goes in? Well, the minimum total is 8%. 5% of that comes from you, out of your pay. But here's the best part, your employer has to chip in another 3%. It's basically free money, a top-up on your salary that goes straight into your retirement fund. Here's a little detail that trips a lot of people up. Those percentages, they're not usually taken from your entire salary. They're calculated on what's called qualifying earnings. For 2026, that means they only look at the bit of your salary that falls between £6,240 and £50,270. It's a key thing to be aware of.
Okay, moving on. For so many of us these days, there's another deduction we need to think about. If you've been to uni, you'll know exactly what I'm talking about. Student loan repayments. They pretty much work like an extra tax just for graduates. It is so important to know which loan plan you're actually on, because the starting points for when you repay are all over the place. Now, I really want to draw your attention to Plan 5 there. It's the new kid on the block. Repayments for this one start in April 2026, and it affects students who started their course in England from August 2023 onwards. And look at that threshold. At £25,000, it's the lowest of the lot for undergraduate loans. Okay, we've unpacked all the different deductions. Now for the moment of truth. In this last section, we're going to put it all together and see what that final take-home pay number actually looks like.
Let's make this real with an example. Imagine someone in Wales earning £45,000 a year, and they have a Plan 2 student loan. We start at the top with 45 grand. Then we take off the income tax. Then the national insurance. Then their 5% pension contribution. And finally, the student loan repayment. After all that, what are they left with? Around £32,577 for the year.
Now, let's compare that. Let's take the same £45,000 salary, but this time for someone living in Scotland who doesn't have a student loan. So the national insurance and the pension deductions, they're exactly the same. But look at the income tax. It's nearly £400 higher, all because of those different Scottish tax bands. But because there's no student loan to pay back, their final net pay is actually about £1,000 higher for the year. It just goes to show you, where you live and your personal situation can make a huge difference.
So, what are the big things to remember from all this? First, that fiscal drag thing is a big deal. With frozen thresholds, your pay rises might not feel as big as they look. Second, your postcode matters. Scotland plays by different tax rules. Third, don't forget your pension. That's part of your pay packet too. And lastly, please, find out what student loan plan you're on. It makes a real difference.
Okay, just before we wrap up, we have to say this, and it's really important. This has all been for general guidance. Everyone's situation is different, and tax can be complicated. So before you make any big financial decisions, please get professional advice that's tailored just for you. And if you are looking for that kind of personalized advice, you can get in touch with the experts at Fairview Accounting Services. Their details are right there on the screen. We really hope you found this breakdown useful. And hey, why not subscribe for more explainers like this one? We love making tricky topics easy to understand.